Hi, everyone. I want to go ahead and talk to you about the midterm 2 that's coming up this next week, and also go through chapters 4 and 8 in our practice midterm for those chapters. So let's go ahead, and I have this in student mode here, as you can see, for our Canvas site, and I'm just going to go to quizzes, where your quiz will be. So you'll click on that, as you know, from midterm 1, just like you did midterm 1, and then we'll have the midterm 2 here. So if you go ahead and you click on that, you can see that what I'm going to do, I guess I'm going to have to actually leave student mode to show you what I want to show you here. Okay. And so when we click on the midterm, you can see that it will open on Monday, June 5th at 12 a.m. That's 12 midnight. I doubt that you'll be taking it right at that time, but then it will remain open until 11:59 p.m. at night on Sunday, June 11th. So you have an entire week to schedule the time that's convenient for you when you will take that midterm. It will consist of 25 multiple choice questions from chapters 2, 3, 4, and 8. Each question, as it was for midterm 1, will be worth 4 points for a total of 100 points. You have 3 hours to complete the exam. So you pick the 3-hour window within that week time period that you plan to take the exam. And then you work through the 25 multiple choice questions. It will cut off on you hard at 3 hours, so make sure you plan accordingly. I don't recommend you wait until 9 o'clock p.m. on Sunday, the 11th, to do that. That would be a mistake. Okay, don't do that. Give yourself some time, maybe towards the back end of this upcoming week, maybe the Friday or maybe Saturday before, so that you have time to review the material that we're going to be looking at for chapters 4 and 8. And then, we're going to look at those today. And then that'll give you time to digest that material and then do well on the exam like you did last time. You'll have 3 hours to complete it. Do not open it until you are ready to complete it. And again, you can use any material from this class, the slides, if you got the book now, the practice midterms that I've given you, all of that is fair game, open book for the exam. Okay, so I think that pretty much addresses everything, but of course you can reach out to me if you have questions on that. Okay, all right, good. So let me go back now. And again, chapters 4 and 8 are here. You can see the module if I publish it, of course. Help me to publish that. There you go. And there's the modules for that. Okay, and of course, if you've gotten this far, you've already clicked on the lecture that will show here after I'm done recording this. So you probably know where all this information is already. I don't have to show you that. So let's just go ahead and let's jump into chapter 4. Now, just a quick review of where we've been for our first midterm. We were talking high level definitional type things. And now going into our midterm 2, as we did with chapters 2 and 3, we're going to continue the discussion in chapters 4 and 8, where we're talking about specific fraud schemes, and that's sort of where we're going as we head into midterm 2 and then complete the course. So you can see, and of course my clicker's always got to decide to malfunction on me while I'm here on video, but you can see that we're talking about billing schemes in this chapter, and we can see that there are different ways of perpetrating a billing scheme. One is creating a shell company, a fake company, essentially. One is a non-accomplice vendor. The vendor thinks that they're paying the company, but there's actually a fraudulent payment to the employee of the victim company, the victim entity. And then personal purchases, individuals making purchases for their own personal use or use their family, rather than making the appropriate purchase where a service or a item of the particular asset or whatever will be used by the company. Okay, so you can see, and we're going to really in these chapters 4 and 8 be focusing on billing schemes and then cash register disbursement. You can see the percentage of the different frauds that some of the studies have shown come from these different sources. We'll get into some of these others as we move past midterm 2 into our final. Remember, our final will not be comprehensive, but we'll continue to talk about fraudulent schemes as we wrap up the course here. And you can see the dollar amounts associated with that, with the large dollar amount for billing that we're talking about here. And then we'll talk more about some of the registered disbursement problems, which you don't really see listed on this slide. Oh yeah, you do. There's the 25,000. So usually billing around 100,000 is the median loss. Registered disbursement about 25,000. Again, we'll get into registered disbursement in chapter 8 in this discussion today, and then some of these others we'll cover in other lectures as we move forward. So taking a look at billing schemes and the perpetrator, and in this particular case, we're talking about potentially an employee. And when we talk about perpetrator, okay, we're talking about probably an employee, probably somebody of trust of the company, and we're talking about the company being the entity, being the victim here. And so the perpetrator, probably an employee, uses a false document to cause a payment to be issued for fraudulent purposes. Fraudulent disbursement is issued in the same manner as a legitimate disbursement. And what we're going to see is sometimes they may set up a shell company. Sometimes they'll be making the vendor think that it's legitimate. So we're calling that a non-compliant, non-accomplice, I should say, vendor. And then personal purchase schemes. They use the appropriate vehicle for purchasing, but then they're not going to, deliver those goods or services to the company. They're going to use them for their own personal use. Okay, so we start to take a look, and boy, my clicker's having fun with me today. Okay, I guess I'll advance the slides this way, or maybe my slides have decided to malfunction on me. So let me reopen those. Okay. Yeah. Okay. So taking a look, some of the shell company schemes. So what happens is the perpetrator, probably our employee, establishes a fictitious entity just so that they can then have payments made to that fictitious entity. They will set up a bank account in the name of the fictitious entity, and they'll form the shell company. So there'll be a certificate of incorporation, or they may form the shell company in another person's name. Now, when they say the best way, they're talking from the standpoint of the perpetrator, the person committing the fraud. And please don't take these as suggestions on phrase best ways. It sounds like, we're advising you to do this, and you shouldn't do this. This is a bad thing. But set up a company under a fictitious name, and then set up the entity's address, home address, post office, bank account. If we're dealing with direct deposit, automated clearinghouse type transactions, then they'll probably set up a bank account. So it's, these days, since checks are often distributed electronically, they'd probably have to have some bank account and a routing number and that sort of thing as to where these inappropriate payments will be made. Now, taking a look at the steps, they will submit a false invoice, and it'll be manufactured looking professional, maybe making it look like it's coming in a online billing platform or something from a legitimate vendor. Now, one of the most important ways to avoid these problems, and we'll talk about ways to prevent and detect these sort of fraudulent schemes a little bit better, but the best way is to have a separation of duty. Remember, we've talked about the separation of duty, and I think I've used the mnemonic ARC, and my pen's not going to work, and I'm not going to fight it. Authorization, record keeping, and custody are the three duties that should be separated. So one individual is responsible for authorizing a purchase, probably a purchasing department or a purchasing agent. Our accounting department records the transaction, and then a third party would actually have custody of that asset. So the way it's supposed to work is if I'm in need of, say, laptop computers, I'm the head of the IT department, I put a requisition in and I request that the purchasing department acquire whatever particular laptops I'm asking them to acquire. The purchasing agent will work with the vendor to order those goods, and they put together a purchase order and they send that to the vendor. And then we have a separate function where the recording, so that all would be the approval process. Then a second function where we will have recording of that purchase order going into the accounting system. And then we would have a custody asset manager that will then receive those computers, tag them, make sure that there's something that's entered into equipment subsidiary ledger and whatnot, where the location is, all of that different thing, making sure that there's the appropriate locks on those things, if they're going to be assets that are going to be maintained within the premises. All of these different things would be done by an asset manager, somebody that's having custody over the items that come in, and then they'll record the receipt of that with the receiving report and whatnot maybe in our receiving department, and they go and make all that information, and then it goes to the accounting department, and in the accounting department they will then go ahead and receive the invoice from the vendor. They will see that there was a proper purchase order, maybe even they have the requisition. They will see that there was a receiving report, and then they will go ahead and they will record that we're now having a payable. And then they will go ahead and we have a separate custody function, it should really be the Treasury Department. They would then go ahead and release that payment, have the electronic ability, whatever, to release that payment. And it goes to that vendor at that point in time. And the payment goes to the vendor. And then once the vendor has received that payment, the information is marked as stamped and paid by the Treasury Department. And then they send that back up to the accounting department to then debit the account payable and credit the cash as that payment is made. That's the way it's supposed to happen. In order for this pattern to take place, okay, the biggest problem is that there was not proper separation of duties. So we were able to create a false invoice. It was approved because the same person that is responsible for approving the item also can process the payment. Sometimes that process that I talked about where the treasurer marks something stamped or they mark something as an approved purchase, whoever is responsible for that isn't really doing a good job in checking these different things. And so they rely on the false documents and whatnot. But if you have good separation of duty and you clearly lay out the different responsibilities the way I just sort of rattled off and articulated, you can avoid a lot of this that is being talked about on these pages. And again, none of this is intended to be suggestive that somebody try this, but these are how these different things happen. Now, collusion is when two or more employees work together to circumvent the separation of duty that I just talked about. And so that's called collusion. So you'd have, somebody in the accounting department working with somebody in the receiving department to act like something was actually received when in fact it was not. Okay. Purchases of services are fraud perpetrators often will rather do that because it's a little harder to track. There's no asset. It's a service. We're probably debiting expense, and there's no actual asset to track at that point in time. However, even for services, if you have the proper separation of duty, the requisition versus the individual that's actually going to receive the service, that would then have to be approved before they actually receive that service. And then, it'd be kind of difficult to track if they actually got the service. But then when that payment is going, the payment should only go to those individuals that we've already, have the treasurer appropriately set up an account for and whatnot. But it gets a little bit more difficult with services than with goods is what we're talking about here. Pass-through schemes, goods or services are purchased by the employee and then resold to the victim company at an inflated price would be a definition of a pass-through scheme. Taking a look how to prevent and detect these sort of shell company schemes. Again, best is to have separation of duties, but maintain a regularly update and approve vendor list. Again, in order for someone, for an entity to be even available to be paid by the treasurer, right? Because we separated the payment from the accounting, there should have been some sort of process where when someone was set up to receive payment, there was some verification that was done that that was a legitimate vendor, probably in the Treasury Department before we can even disperse funds. By the way, separation of duty in an automated environment, we can assign certain rights to individuals in the computer system. So individuals that have the authority to make entries in the accounting records should also not have authority to release funds to a vendor through online banking or automated clearinghouse type transaction. Independently verify all vendors before payment. Again, and that's sort of what they're talking about there. If someone to be an approved vendor that can be paid, somebody should have entered them in the system, and it should not be individuals who have the ability to make changes, disperse funds, make changes to the accounting records, and that we should have somebody at a high level doing that. Identify shell company invoices if there's lack of detail, mailing addresses, maybe indicator of fraud. Perhaps you're seeing payments going to one of your employees' address. How is that happening? Okay. Consecutive number of invoices over a period of time. You have several invoices, invoice 100, 101, 102, 103, all happen on the same day to the same vendor. Could be that that's legitimate, but you might want to check out those sort of patterns, and then reviewing payables and sorting payments by vendor and invoice number. Again, if we have a vendor that all of a sudden seems particularly popular, we never saw them before, why are we all of a sudden ordering all these goods from this particular invoice, particular vendor? Again, these may be legitimate, but these are the kind of things you'd want to investigate if you're trying to detect some sort of shell company. Testing for shell company schemes, investigate budget overruns. Why are we all of a sudden spending so much money on computers when we hadn't budgeted for that, right? Conduct horizontal analysis. Remember, horizontal analysis, also sometimes called longitudinal analysis, is looking at changes over time. All of a sudden, we see a particular type of expense going up from one year to the next, a big spike in purchases by vendor, whatever, maybe something unusual is going on there. And then unexplained increases in quantity of items being purchased. Why do we all of a sudden need 100 laptops? What's going on? Okay, continuing, monitor trends in average unit price. Again, maybe there's some sort of higher price going on. There could be, not really mentioned here, issue with a potential kickback, where the vendor charges too much and then they kick something back to the fraud, the employee committing the fraud. Okay, and so they say, hey, charge a little extra and then give me, split the extra money with you, whatever. And so that's why it's important to separate the purchase authorization, the purpose of purchase authorization, the approval of the purchase order, from the actual person receiving or ordering those goods. So the IT manager may get pretty chummy with a computer vendor or something, and then they start to work these kinds of things out. Whereas if you have a separate purchasing agent who's in the purchasing department, whose whole job is to make sure that we're obtaining good prices for the items that we acquire, would be a good way of avoiding this sort of thing, where all of a sudden the prices are going up. Things not normally purchased. We're an accounting firm. Why are we purchasing stereos? Okay, that kind of thing. compare vendor address to employee's address, and you can do that electronically. Run reports of average turnaround time for invoices. Wow, we just ordered this stuff and then all of a sudden things being paid. Meanwhile, there should have been some time in between where we had to receive the goods, etc. Again, best way to avoid all this stuff, separate authorization, record keeping, and custody. Okay, looking at some other things, looking on the internet to see if the vendor even exists. Verify vendor's address through doing some sort of look on the internet to see what the address is. Identifying the particular employee. So now you've discovered something's going on. You know, well, who's doing this? So look to see, well, who in public records, who owns this corporation? Turns out that we're making payments to. Turns out that they give you the employee's name there. Okay, names, addresses, social security numbers. Is the payment, if you're using direct deposit, which you probably are, for your payroll, is it going to the same bank clearinghouse number? Okay, is it going to the same routing number? Well, why are we having a routing number for supposed vendor? Same routing number is being used for our employees' payroll, right? And then if there's some sort of mail drops and whatnot being used, maybe you do some surveillance to see who's picking those up. Okay, now non-accomplice vendor. So the vendor is not part of the scheme, but they're going to be using the vendor as the vehicle for which they will go ahead and receive inappropriate payments, or maybe even receiving goods and services that they're using for their own personal use. So they're not creating a shell company, it's an actual vendor, but they're leveraging off that vendor to commit these different schemes. So pay and return schemes, what happens? They sit there and they go ahead and they order the good and then they return the good, but they get the payment for that item. And so they will go ahead and pay for the item. Not necessarily return the item, pay for the item, and then say, oh, okay, we are going to give the item back or whatever. We're going to void the purchase of that. And when the money is given back by the vendor, it is stolen by the employee. Okay, so it's a payment that is owed to a legitimate vendor and it's intentionally mishandled. Rather than be deposited in the proper account, they go ahead and they have the money deposited in their account. Double pay an invoice. They induce the vendor to pay twice, and that second payment, of course, goes into the account of the perpetrator of the fraud. Pay the wrong vendor. So they go and they pay the wrong vendor, then they come back to the wrong vendor and say, oh, sorry, we didn't mean to pay you. Please return that money. And when the money is returned, it doesn't go back in the company's account, it goes back in their own personal account. Overpay the invoice amount. Okay, and all these things, they go back to the vendor and they say, we didn't mean to pay. Can you please refund that money back? Or we paid you too much, refund the difference back. And instead of the money going back into the company's bank account, it goes into their own personal. Purchase too much merchandise, and then of course they want to return it. And when they return it, the money comes back, goes into the wrong account. Okay, overbilling the non-accomplice vendor. Fake invoice is created for a vendor that regularly does business with the victim organization. And again, when they say, well, we don't want this item, we already paid for this, please give us the money back, they keep the money. Okay, so this is all money coming from the vendor. From the vendor standpoint, it's a legitimate reason to be returning money, but then it isn't deposited into the correct account, it's deposited into the perpetrator's account. Personal purchases, employees will make purchases and instead of bringing the laptop to the company where it can be used, they go ahead and they bring the laptop home and they have the service done at their home for their friends, families, and whatever. Okay, now perpetrator causes the victim company to order and pay for the unneeded asset, and then the perpetrator authorizes the invoice falsifies documents for the purchase order, altered an existing purchase order, makes a false purchase requisition, misrepresenting the nature, changing the delivery address of the purchase, etc. Again, I know, it's starting to sound, we got it, John, but I keep repeating, separate the authorization, the issuing of the purchase order from the accounting record keeping to the actual custody of that asset. It doesn't come straight to the person that requested it. It first goes to an asset manager who then says, okay, this is the location, this is the ID plate that we're going to put on the item. Even after items are handed out to employees, so we get our employees laptops, right? There should be at least annually a reconciliation between the physical records, between the records of where those assets are and who's holding that asset, and go and look at it and see that it is still, there. If you don't do that periodically, eventually employees who maybe originally got an asset for legitimate use on the job will walk off with the thing if you lose track of it. So it's not only at the time of purchase, but that should be an ongoing thing. Taking a look, personal purchases on credit cards. So the employee make a purchase for something that should have been for legitimate purposes, and they go ahead and they get a credit card to make legitimate purchases, and then they go ahead and use that for their own personal use. If you give, for example, an employee a credit card for business travel, then there should have been a travel order, okay, that should have been, the period of that travel order should be the only time that that credit card is being used if it's, say, for travel. And you can easily set up a control that if the employee is using that card when it is not for, when they are not on travel, that's not allowed. You would question that, right? Company cards could be stolen. Charge account, employee order items using an existing account or vendor, and then they go ahead and they use that for their own personal use. The other thing that can happen is they charge something on their credit card, right? And then they go ahead and they're supposed to be using this for inside the company, but then they go ahead and they return the items, right? And so they get what? They get money back, but they've already submitted their credit card invoice for payment, and the return isn't indicated on the credit card payment. And so they get to keep that money when they return those items. Again, all of these things can be avoided by good separation of duties, et cetera, like we talked about. Okay, good. So preventing and detecting. Does someone really need a credit card? Not really quite where they're going here, but issue credit cards to those individuals that actually need them. Okay, more credit cards you issue, the more opportunity you have for this sort of thing. Only original support for the reimbursement should be allowed. Card issuers should send 2 copies of the statement, one to the individual that's using the card, but to another individual within the organization, so we can check, hey, there was a charge here during a period of time where it couldn't possibly be for legitimate purposes or whatnot, and that could be investigated. And again, card statements compared with employees' vouchers for duplications and monitored for unexplained increases in purchase levels. And of course, all of these things, particularly with a lot of the data analytics software that are available these days, can be used to identify these types of things. Okay, good. Now, that is our chapter 4 material, but let's go ahead and take a look at chapter 8. Okay. And as we look at chapter 8 now, put myself back in slideshow. Okay. Now we're talking about fraud being perpetrated at the cash register. So money being taken out of the cash register, or money being handed to an employee who then goes ahead and, instead of putting that money in the cash register, pockets the money. Okay, so there could be a couple of different things. False voids, false refunds are, the way that a lot of times these cash register thefts happen. And you can see those are down there. As we mentioned in chapter 4, we saw the same slide, 7.8, but notice, on average about $25,000. So that can still be significant. Okay, so let's take a look at these false refunds, false voids. False refund: the customer returns an item, merchandise purchased from the store. The item is placed back into inventory, and then the purchase price is returned to the customer. This is all legitimate. But for a fictitious refund, what happens? The perpetrator takes cash from the cash register and the amount of a false return. They go ahead, and again, if the person receiving the money didn't have the ability to update the accounting records, this second part can happen, separation of duty. But they go ahead and show the item being returned into inventory when in fact, there was never, it was a fictitious refund. The thing never actually came back. Now, one of the ways that you would find this is not really mentioned here, but there should be a periodic reconciliation between your inventory items and what the accounting records are saying. So if the person didn't really return the item, then what's going to happen? The physical count of the inventory is going to be less than what the accounting records are showing. If the individual is debiting the inventory count, but the stuff was never returned, then you're going to see a higher number of items in your inventory count than you have in the physical count. So you in the inventory records than you have in the physical count. So periodic reconciliation, that would also help detect this problem. Okay, overstated refunds. So what happens? Someone says, hey, I'm returning this thing, and instead of returning $100, they returned the $100 for a $100 item, but they marked the return for being for $150 on the item, and of course they keep the excess $50 in that particular example. Credit card refunds: it appears to credit the customer's credit card rather than a cash disbursement. Meanwhile, the perpetrator does not have to physically take the cash from the register, and the refund is actually going to the perpetrator's credit card. False voids. So we have a sale, okay, and we generate a disbursement from the register. What should happen is there should be a copy of the customer's receipt attached to the void slip. Manager must generally approve voided sales, and you've probably experienced this where you try to take something back and they have to call a second manager over to approve that return or that void of that sale. That's good separation of duty. What happens? There's a rubber stamp approval. The person isn't doing the things that they're supposed to do. That would be could lead to a false void, or management that's supposed to be approving this, and the employee actually conspire, what we're calling collusion. When we're dealing, perpetrators typically do not make any effort to conceal shrinkage, and what they'll do is they'll have a lot of several small items that they think are falling below a particular level that it's going to even be detected. The disbursement schemes leave the victim's organization book in balance because they're not even trying to hide it, and they then don't take any further action to try to hide it. Now, of course, they'd have to be dealing with fairly small dollar amounts, and so we talked about that. I think last time we called that death by 1,000 cuts, right? Over some time it'll build up, but they know that any one transaction is going to be looked at, and they just sort of try to fly under the radar with that. Okay, so they make them small disbursements. As we were mentioning, they're destroying records, figuring, hey, they're never going to investigate this. Again, these have to be pretty small amounts. And so they just destroy the documents, steal the cash, whatever. And they're hoping that these amounts are going to be small enough that no one's going to discover them. Okay, so how do you detect these cash register type schemes? Again, separation of duties is the way to do this. Okay, making updates to accounting records and receiving cash at a cash register should be separate. Management approval for refunds voided. Closely guard access to control key or management code to be able to even put in for a return to happen. We have a separate manager that has to make the code for that return and prohibit cashiers from reversing their own sales. Require proper documentation, require cashiers to maintain a distinct login code and so we can follow their activity. And again, they should only have certain rights. Don't let them have the right to reverse their own sale or even void a sale. And it has to be a supervisor that does that, and periodically generate reports of all reversing transactions. So we see a particular employee is processing a lot of these. What's going on? How come? Okay. Look for a large number of transactions below the approval amount. Okay. Again, cut by death by 1,000 cuts. You shouldn't see a lot of these low dollar ones, and all of a sudden we start seeing them spiking up. Maybe we're doing a horizontal analysis on that. We'll follow up. Institute store policies encouraging customers to ask for and examine their receipts and randomly call customers. And, from the customer standpoint, they're thinking, oh, they really care as to why, we had this return of this item. So it seems like good customer service. In fact, you might be able to talk to the customer and understand what they didn't like about the product and offer them something that better suits their needs, right? So it sounds like a sales call, but think about it. You could also sit there and do an existence check where the customer comes out and says, I never returned that. I'm using this thing right now. I'm looking at my laptop right now. I'm talking to you on the cell phone that I, supposedly returned. Okay, and you find that out through periodically calling. And the bigger the entity, but if you have an internal audit department, these are the kinds of things an internal audit department would probably be doing to help identify these type of things. Okay, good. So with all that, let's go ahead and let's take a look at some questions. And again, as you know, as well as you did on the first midterm, understanding these questions are key to then doing well on our midterm 2 that will be coming up here soon. So in a blank scheme, the perpetrator uses false documents to cause a payment to be issued for fraudulent purposes. That's the billing scheme. We've talked about skimming and larceny in other chapters, but obviously if we're making false documents, that's part of a billing fraud. Fictitious entities created for the sole purpose of committing fraud. We're calling those shell companies, okay, creating a fake company, right? Number 3, in order to start up a shell company, the fraudster who are raising funds for themselves, okay, the fraudster will most likely need which of the following? And yeah, they're going to incorporate, they'll have a mailing address, they'll have a bank account, a routing number. All of these things are the type of things that they would need to obtain to do this. Warning signs of a shell company include which of the following? Invoices lacking details. You saw that. A vendor that is not found on an internet search, right? An unexpected incident made an increase in a particular, and we're talking about consulting expenses here, but any type of expense that all of a sudden spikes up. We're doing a horizontal analysis, for example, year over year, month over month, or equipment being purchased. Okay, so all of the above there. Number 5, blank are schemes in which employees intentionally mishandle payments that are owed to legitimate vendors. That's our pay and return, right? They're mishandling those. They're going to be keeping these funds as they're returned, right? Number 6, which of the following controls can be used to prevent or detect personal purchases on company credit cards? And you can see monitor credit card expenses for unexplained increases in purchasing levels. Also, why is an accounting firm purchasing a bunch of couches or something, or furniture all of a sudden? Could be legitimate, but you can probably do some sort of review of things, just don't seem in line with legitimate purposes of the company. Okay, a situational question here for number 7. Eli Adams is an account payable clerk. By forging signatures, he was able to procure a company credit card. He recently bought home stereo equipment. There you go, stuff that's probably not going to be used in the business, and put it on his company credit card. When the credit card statement arrived, he prepared a check to the credit card company, buried the merchandise, the purchase in the monthly expense of the company's largest cost center, knowing his manager generally is inattentive, etc. This is a personal purchasing scheme, following below that radar, etc. How do you avoid this? Wait for it. Separation of duty. Okay, the person that can authorize the purchase should not be the same person that is going to directly receive that asset. Ultimately, they have to request it. That request goes to the purchasing department. It comes in to receiving department. Ultimately, it may be given to that employee that ordered it, right? But it has to have gone through a third party at that point, or a second party, separate person. And then, of course, the recording needs to be done in the accounting records by separate, and then the release of the payment, the custody, the ability to release a payment is separate from the people that update the accounting record when the actual disbursement is made. You separate those things, you do it like that, you're going to avoid a lot of this kind of personal purchase schemes, etc. Number 8, an excessive number of reversing sales transactions. The register is an indicator of what? Registered disbursement, right? All of a sudden they're saying, hey, there's a bunch of returns here, and in fact there weren't. They're just keeping the money. Which of the following can be used to conceal false refunds? And this, of course, should have been D. I'm not sure why my D went away here. But let's take a look. Destroying the registered tapes, issuing funds below a review limit, the death by 1,000 cuts, forcing inventory totals, in other words, saying that the item was returned when in fact it wasn't. All of the above are these. And again, having good separation where somebody has to approve the refund would be a good way of avoiding this. And then, as I mentioned, reconciling the accounting records to the actual physical inventory. Number 10, the best way for an organization to prevent fraudulent register disbursement is to, and I've said it now several times, separation of duties, the authorization, the record keeping, the custody. Okay, so I think that's a good discussion for you to look a little further into in the chapters 3, 4, 8 material. And then, as I mentioned at the beginning of the class here, we will have our midterm coming up in this next week. So make sure that you are, getting in there and taking it during the times that it will be available to you. Again, it is going to be 20 multiple choice questions. It'll open on Monday, June 5th, and it'll stay open until Sunday, June 11th. Pick a 3-hour time period there to work the 25 multiple choice questions. Okay, guys, we will see you for the next discussion. Good luck on your exam this week.